We continue with our discussion on balance sheets under Unit 4 of Financial Reporting and Analysis. And in this particular video, we're going to talk first about a particular kind of assets which are known as current assets. So what do we mean by current assets, what these current assets are, and how can we basically decode these assets that are there, right? So we will continue to look at our sample balance sheet for Tata Steel. So that's Tata Steel sample balance sheet that we have, the asset side of it. And within this, we are more bothered about looking at what these current assets are. So we see 6 headers there broadly. There's something called as current investments, inventories, trade receivables, cash and bank balances, short-term loans and advances, other current assets, right? Let's try and understand all these one by one. So what do we mean by current investment? So let's start with the simplest one of this, which is D, that's cash and bank balances. Any company will either hold some cash or hold that money in terms of bank balances, right? All this is liquid cash which can be used immediately. So this cash is available for the firm to be used immediately. It's cash that is available in the bank account or in the company's own hands, and that portion is called as cash and bank balances, right? Next, we move to some of the more trickier parts. So we look at what is called as current investments. Now, current investments are investments which can be readily converted to cash, investments that can be converted into cash readily, right? Which means these are easily marketable. In some cases, they are known as marketable securities, right? Which means you can sell them immediately and you can make money on them immediately. What are marketable security? You could have stocks, shares basically. You could have bonds. You could have some other instruments that you've bought, but you basically are able to buy or sell these securities immediately, and hence they're called as marketable securities. They're called as current investments. Remember, the current investments portion is these are those investments which are held for the purpose of investing, buying and selling, right? These are basically also known as cash equivalents. In certain cases, these two can be clubbed together and said as cash, which is cash and bank balances, and cash equivalents, which are current investments. So current investments can be either called as current investments, they could be called as marketable securities, or they could be called as cash equivalents, because the idea for these investments is to get readily converted into cash, right? That's your current investments portion. Let's look at the other ones. So we look at the next one, which is inventories. So what is inventories? Any kind of raw material that you have purchased but not used, any kind of finished goods that you have, which means you have the ready good available that you can sell, but you have not yet sold it, and anything in between these two, which is basically what is called as work in process or work in progress, right? So raw material, finished goods, and anything that is in the process of getting converted from raw material to finished goods is a part of inventories, right? Why are these called as current assets? Is because your idea is to not keep too much raw material. Your idea is to quickly convert raw material into finished goods and be able to sell it quickly. That's what a firm should do, right? There is no point storing what you produce. It's always a good idea to keep selling it quickly so that you keep realizing it in terms of cash very quickly, right? So all these are again parts of current assets, and these are essentially known as inventory. It depends on what kind of inventory classification the company wants to do. We've already seen how inventory gets accounted in terms of LIFO, FIFO, and weighted average methods under our income statements. But broadly, all these items which can be sold quickly are considered as inventory. Now remember, it is not hard and fast that we define current assets as less than 1 year. While that is the broad technical definition, ideally you could use a definition for current assets that basically says that these are assets which are held and can be recognized in terms of cash in less than a business cycle. In certain cases, the business cycles are longer, right? I'll give you a simple example, and these are exceptions usually. In most cases, the less than 1 year definition work. In some exceptional cases, like if you look at the sugar industry or if you look at the tobacco industry, there the inventory is longer. Even in the real estate industry, you will find that the inventory is longer because they keep land with them, and that is a part of inventory, and land cannot be easily converted into cash as soon as you want it, right? That's your inventory. That's the portion of inventory that is considered as a current asset broadly, right? So effectively, current assets are those portions of the inventory or those raw materials, finished goods, which you expect to sell quickly and convert them into cash within the business cycle. Most of the time, it is less than 1 year. It is also not necessary that every company has inventories. So, for example, if you were to look at a services firm, like let's say Infosys, Infosys has no inventory, right? There is no inventory or very little inventory in that context because you're selling out a service, you're selling out software, and you can't store inventory around that, right? So it's not necessary all firms have that. We move on to the next one, which is trade receivables, also known as debtors or sundry debtors as per some textbook. Sundry means extra. So additional debtors that are there is what is trade receivables that we find, and these are sales that we have done but payment not received, right? So we are expecting the payment to be received faster. Usually this is less than 1 year. If you don't expect it to come in 1 year, then either you classify it somewhere as a non-current asset or you classify it as doubtful, right? Now, trade receivables may not always materialize. Remember, we had said that the balance sheet, so for example, they have 13,000 crore of trade receivables. It is not necessary they will receive all of this money. So in certain cases, trade receivables can turn into what is called as bad debts, which is why we have to be careful while using these numbers and definitions directly off the balance sheet, because they may not represent the fair value or market value in terms of what can be achieved if you were to, let's say, take out all these receivables immediately. It is not necessary that all the clients pay exactly what they owe you, right? However, trade receivables in general, if we keep things simple, are all those assets that can again be readily convertible into cash immediately as and when needed. So that's why it is called a current asset, right? Then we move on to the next one, which is what is called as short-term loans and advances. What is an example of short-term loans and advances? Let's say the company gives a loan to an employee for the period of 6 months, right? For 6 months. That's an asset for the company. It's a loan for the employee, but it's an asset for the company because the company is going to receive this money back in 6 months, right? The company could be giving a loan to someone else as well. It could be giving a loan to one of its customers for a small period. In a sense, uh, debtors are customers who have been given a loan, right? You've allowed them to purchase the stuff without really paying for it. In a sense, they are also kind of assets. So you could be giving a loan to a customer, you could be giving a loan to a supplier, you could be giving a loan to a third party, you could be giving a loan to anyone. It could be an employee, a director. All that falls under short-term loans and advances, right? You could also be possibly having a very short-term lease. Let's say the company wants to book an office for 6 months in Dubai, right? They might have to go and give some rentals. These rentals may be paid in advance. Those may be short term. So the deposit money sometimes that you give for a rental, that may be counted as a short term loan and advance, right? So that's what would come in as a current asset as well, right? And then finally you move to other current assets, what could these other current assets be? Always note from the company's perspective, anything that you have paid in advance, right? Paid in advance will come here as other current assets, right? So what could you have paid in advance? You could have paid some expenses in advance, so prepaid expenses. A supplier comes to you. If you don't pay your supplier, that's a payable. But if you pay upfront and you pay more than what is required, that you've created an asset for yourself because you've paid the money and now you'll get the services and goods in lieu of that at a later point of time, right? So that's a current asset. Any kind of rental deposit that you have done is going to be a current asset. Any payment made in advance, right? Any payment made in advance is going to be a current asset, and that's going to get classified as other current assets, right? All these flow into other current assets. There could be some minor differences in other current assets as well. When you do go at a further stage and start looking at these numbers for a company, for Tata Steel, for example, you see all these note numbers. So these are all note numbers and these are all page numbers, right? On each of these pages, you get details of what these notes are. So what these other current assets are, you can go and look on page 21, on note 21 on page 244, and you will find what these other current assets are. We have given a few examples. At this stage, we don't necessarily need to make it that complicated, but that's what your other current assets would be, right? Let's recap what we have done. Cash equivalents or cash and bank balance, highly liquid short-term investments that are too close to maturity, that significant changes in values from changes in interest rates is minimal, demand deposits with bank, liquid investments with original maturities of 3 months or less, T-bills, commercial paper, all these are kind of very short-term bonds that are there. For cash and cash equivalents, basically your cost and fair value are likely to be kind of, very, very close. And even if they're different, they're like immaterial in terms of the difference. So you don't worry too much about that. Then marketable securities, debt or equity securities that are owned by a business, sort of traded in public market, and whose value can be determined. They are immediately convertible to cash. So cash equivalents, marketable securities are all taken together typically to understand what is the cash position of the company, because all these three can be immediately converted into cash, right? Cash is already cash. You can sell all your securities and convert them to cash. You can take all the money out of banks. That's all available for you to use, right? Then we look at the other areas. So trade receivables is amounts owed to the business by customers for products and services that are delivered but not yet paid for. These are included as trade receivables. Allowances have to be made for bad debt. Bad debts expected out of these total receivables amount, right? Then inventories are physical products on hand, such as goods that will eventually be sold to the end customers, either in their current form, finished goods, or as inputs to the process, which is raw materials and work in progress. So work in process. So raw material, WIP, or finished goods, all of them combine to give you the inventory, right? And then you look at other current assets, short-term items not easily classifiable into other categories, something like prepaid expenses. Prepaid expenses are normal operating expenses that would have been paid in advance, right? The advance payment creates an asset out of a transaction that would normally have resulted in an expense, right? So examples include prepaid rent, prepaid insurance, you're given a small security deposit, you've paid to your customer in advance, you pay to your, supplier in advance. All these are examples of prepaid expenses that are available. Within these other current assets, you also include any kind of interest that has been accrued to your bank account but not yet paid, right? For example, let's say my bank account has 1000 crore and it's supposed to be paid on, let's say, 30th of April. I'm going to get the interest on 30th of April. On 31st March, I might have maybe about a 5 crore of unpaid interest, right? It'll show there in the account, but it has not yet been paid. That's an asset because it'll come back to me in the short term, right? That is what is called as another current asset. Anything that can't be classified into cash, marketable security, trade receivable, inventories, but is going to generate cash for the company in near future is a current asset, right? So that's your definitions of current assets. That brings us to an end to this particular section. As we end this section, a couple of quick questions. Explain what do you mean by a marketable security. Explain what you mean by prepaid expenses. I would also want you to do a small case where you pick up any company and look at these line items, of current assets, right? So show what these current assets are, what has been the movement in these current assets, what is the inventory number, what is the receivables number for any company. You can pick up any company and try and do that once, right? Thank you.